Hey everyone, welcome back to Corporate Decoder. Today, Olenox Industries Inc. just filed an 8K, and I am seeing some interesting deal making that tells a story. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company just bought another one, and the details of the deal reveal a lot about their strategy and potential risks ahead. Alright, let's dive into this filing from Olenox Industries Incorporated, ticker symbol O.L.O.X. This is a current report, basically an update on important company events. The big news here, filed on the 16th of June 2026, is that Olenox has completed an acquisition. They've bought CS Digital Ventures Incorporated. The deal was structured as a membership interest purchase agreement, and it looks like Olenox now owns 100% of CS Digital. So, what exactly is CS Digital Ventures Incorporated? The report tells us it is a digital infrastructure company. Its focus is on building and running data centers that use a lot of energy. They're involved in things like Bitcoin mining and high-density computing. At the time of the deal, CS Digital had about 35 megawatts of power capacity already up and running. That is a solid base for their operations. Now, let's get to the juicy part, the money. This acquisition wasn't cheap. The total price tag has a few different pieces. First, there is an upfront payment of $30 million US. This is split into two parts. $14 million of that will be paid in newly issued shares of Olenox's Series E preferred stock. These shares are valued at $100 each, and the company is issuing them at $100 per S-share. The other $16 million is being paid in the form of an unsecured promissory note issued by Olenox to the sellers. This means Olenox owes the sellers $16 million, but it is not backed by any specific assets, making it a bit riskier. But that is not all. Olenox has also agreed to issue warrants to purchase a total of 1.5 million shares of Olenox's common stock. These warrants are broken down into 3 batches of 500,000 shares each, with different exercise prices: $5, $7, and $9. Per S-share. On top of that, there is a potential earnout. Olenox could pay up to an additional $20 million in Series E preferred stock. This extra payment depends on CS Digital hitting certain performance targets related to cumulative revenue and adjusted earnings before interest, taxes, depreciation, and amortization, or EBITDA, after the deal closes. These details are laid out in the main purchase agreement. Scroll. I warrants to purchase an aggregate of 150,000 shares of the company's common stock, par value $0.01 per S-share. The common stock comprised of 3 equal tranches of 500,000 shares each, with exercise prices of $5, $7 and $9 per S-share respectively. Collectively, the warrants and eyed up to an additional $20 million US in shares of Series E preferred stock. The earnout shares issuable upon the achievement of 2 post-closing milestones tied to a cumulative revenue and cumulative adjusted EBITDA of CS Digital, in each case as further described in the amended purchase agreement. Scroll. This deal has some important restrictions and requirements. One key point is what is called the exchange cap. Essentially, there is a limit on how many shares of common stock can be issued or become available to be issued through things like converting preferred stock or exercising warrants. This limit is set at 19.9% of the company's outstanding common stock right before the deal closed. This is a common rule to prevent excessive dilution that could upset major stock exchanges like NASDAQ. Scroll. No shares of Series E preferred stock shall be convertible into common stock to the extent that, after giving effect to such issuance, the aggregate number of shares of common stock issued or issuable pursuant to either conversion of the Series E preferred stock, the exercise of any warrants issued in connection with the issuance of the Series E preferred stock, or the exercise, conversion or exchange or any other securities issued in the same financing transaction or any related transaction that are required to be aggregated pursuant to NASDAQ listing rule 5636 or any successor rule, which would exceed 19.9% of the company's outstanding shares of common stock immediately prior to the closing of such financing, the exchange cap. Scroll. To get around this cap, especially if Olenox wants to convert that Series E preferred stock into common stock or allow those warrants to be exercised beyond that limit, they need something called stockholder approval. This means they have to hold a meeting of their shareholders and get enough votes to approve these actions. The agreement says Olenox will try their best to hold this meeting within 90 days after the deal closed. If they don't get the approval, then they have to keep holding shareholder meetings every 3 months until they do. Interestingly, if they fail to get this approval, it won't negatively impact the value or rights of the Series E preferred stock or the warrants themselves. This is a crucial step for the company's future flexibility. Scroll the amended purchase agreement provides that the company shall use its best efforts to convene a meeting of its stockholders to seek the requisite approval of the company's stockholders, as required under applicable rules of the Nasdaq Stock Market LLC, Nasdaq, including Listing Rule 5635, the stockholder approval, to allow the conversion of Series E preferred stock into common stock and T or the exercise of warrants to exceed the exchange cap within 90 days after the closing. And if the stockholder approval is not obtained at such meeting, to convene a meeting of stockholders every 3 months thereafter until the stockholder approval is obtained. The failure to obtain stockholder approval will not give rise to any increase in the stated value of accrual of dividends or interest on redemption, right, with respect to decrease in the conversion price of, or any other economic consequence favorable to the holders of, the Series E preferred stock or the warrants. Scroll there is also a beneficial ownership limitation. This is another safeguard even if Olenox gets stockholder approval. No single holder of the Series E preferred stock or the warrants, along with anyone they might be associated with, can end up owning more than 19.9% of the company's outstanding common stock or voting power. This helps prevent any one entity from gaining too much control. Once Olenox gets stockholder approval, they've also agreed to file a registration statement with the Securities and Exchange Commission, or the CC. This document is for the resale of the common stock that could come from converting the Series E preferred stock. They have to file this within 60 days after getting shareholder approval and then work to get it declared effective by the SEC as soon as possible. This is important for the holders of that preferred stock as it allows them to eventually sell their shares on the open market. The deal also includes non-competition and non-solicitation clauses. Two key people, Bernardo Schuchman and Shanti Silo, are restricted from competing with the business or soliciting employees for 2 years after the deal closes. There are some exceptions, like if they continue to own or work for certain companies listed in the agreement. This is standard practice to protect the acquired business. As expected, the purchase agreement has typical representations, warranties, and indemnification provisions. Basically, the sellers are making promises about the condition of CS Digital, and if those promises turn out to be false, they could be liable. Claims for breaches of these promises generally have an 18-month window to be made, and there are limits on the amount they'd have to pay, sort of like insurance deductibles and maximum payouts. These limits don't apply to really fundamental issues or serious problems like fraud. The report also mentions the seller note separately. Again, this is an unsecured promissory note for $16 million. It includes standard terms regarding interest when it is due, ways to pay it off early, and what happens if something goes wrong. The details are filed as an exhibit, which is like an appendix to the report. Let's also touch on the warrants. These are the options for the sellers to buy 1.5 million shares of Olenox common stock at those set prices. Crucially, these warrants can't be exercised until Olenox gets that stockholder approval we talked about. The finer points of the warrants, like when they expire and how they adjust for things like stock splits, are also detailed in their own exhibit. And finally, regarding the Series E preferred stock, Olenox filed a certificate of designation with the Delaware Secretary of State. This document officially lays out all the rights and details of these new shares, including that they generally don't have voting rights except when required by law. It also reiterates the conversion limitations and that the conversion price is fixed. This filing happened on the 17th of June 2026, just a day after the acquisition agreement. This report also includes a standard cautionary note regarding forward-looking statements. This is just a legal disclaimer telling investors that some statements in the report about the future could be wrong. They mention that things like integrating CS Digital, getting shareholder approval, and CS Digital hitting its performance targets are all subject to risks. They acknowledge that actual results could be very different from what they expect due to market conditions, competition, and other factors. This is a common but important part of these filings. Now, let's put this all together and think about what this acquisition means for Olenox. They are paying a significant amount of money, $30 million up front, plus potential future payments and warrants, for a company in the data center and crypto mining space. This sector can be very profitable, but also very volatile, dependent on energy costs and the price of cryptocurrencies or demand for high-density computing. The company is issuing a substantial amount of preferred stock and debt, which increases its financial obligations. The reliance on stockholder approval for key conversion and exercise rights is a major hurdle. If they don't get it, the flexibility to use these new shares and warrants is limited. Looking at the external context, Olenox Industries Inc, ticker O.L.O.X, has a relatively small market cap, around $6 million, and only 31 employees. This acquisition, costing $30 million up front, is a massive step for a company of this size. significantly expanding its obligations and operational scope. Recent news mentions this acquisition and a surge in their stock price, likely due to optimism about the data center and AI compute business of CS Digital. However, there is also a mention of a Nasdaq delinquency notice from May. This suggests Olenox might have been struggling to meet exchange listing requirements before this deal. Combining a massive acquisition with existing potential compliance issues creates a very dicey situation. The biggest risk here is the execution of this deal. Can Olenox integrate CS Digital's operations effectively and realize the expected benefits? Can they manage the debt and the preferred stock obligations? And critically, will they get that all-important stockholder approval? Without it, the strategic value of the newly issued equity and warrants is significantly diminished. The historical performance of companies making such large acquisitions relative to their size, especially when facing potential Nasdaq issues, is often not pretty. Many see significant drawdowns. For example, companies like Bed Bath & Beyond or Rite Aid, facing financial distress and major strategic shifts, often experience prolonged periods of stock decline. A rule of thumb is that about half of microcap reverse splits end in eventual delisting. And while this isn't a reverse split, the underlying financial pressure and the need for shareholder approval to maintain Nasdaq compliance and unlock share value point to a similar precariousness. A $1,000 investment in a company undergoing such a transformation and facing compliance challenges might see a significant portion eroded if things go south, potentially losing 30 to 70% or more over the next year or two if the integration falters or Nasdaq issues aren't resolved. My biggest concern is the sheer scale of this acquisition relative to Olenox's current size and the added complexity of needing stockholder approval for critical parts of the deal. What I am actively watching for is the company's progress in securing that shareholder vote and how they manage the cash flow needed to service the seller note and operate the combined entity. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings.